So what is long-term financial liability? Okay. Now basically, if you have any liability on the balance sheet, okay, you will record the liability at the value that you have actually received, right? If you took a loan of, let's say, 100, you record a liability for 100, correct? But remember that if you, let's say you issued debentures, you have issued debentures and you also paid some cost, prospectus or issue cost. So effectively, the amount you receive will be reduced by the amount of issuance cost, right? So your liability should be the amount you're effectively paying out, but you have received less money. So you will record accordingly the liability based on the amount that you have to pay back. Okay. Now this is most important. I'll come to this with a demonstration. But just from this formula, whatever is your liability every year, this amount will be multiplied by the effective interest rate. And this is called effective interest. So remember I told you in the income statement, I don't record my interest charge as per coupon. I record the interest charge as per effective interest. So the word effective interest is nothing but this formula. Make a note of this. It is called opening liability into effective interest rate. Make a note of this. So when I tell you what is my income statement charge, you will not say it's a coupon. Your coupon will be different. Your effective interest will be different. The formula will be effective interest rate into opening liability. Now, why I said opening liability? Because every year, the liability amount will keep changing on the balance sheet. Okay. So, balance sheet, my liability amount will be the amortized cost that will keep changing. And that changing amount will help determine my interest charge. So I hope you realize that means my interest charge will also keep changing every year. Right? It changes every year. Fine. And that's to take care. Now, obviously, the cash flow, you will earn interest based on coupon, but the amount of cash flow will be based on the proceed that you've done. Okay. So, you know the cash flow is comprised of three things: CFO, CFI, and CFF. CFO is cash flow from operations, and this will take care of the interest. CFO is cash flow from financing, and this is nothing but the amount that you received, right? This is a finance you received. And this amount will reduce every year by the finance that you paid. How much you received is the loan, that is plus, and how much you paid off is the repayment, that is minus. Okay, and CFO is going to be the interest component. Okay, so are we clear this? I'll show an example of this. So this is very important. Yeah. Okay. So once we go to the example, we'll go back to earlier slide to connect the dots. Okay. Now let's look at an example. I have a 3-year debt, which is a bond. $1,000 my face value. Coupon is 2%, and I've issued it for 918. So this is nothing but my current market price. This is my face value. This is the duration, and this is my coupon interest. Okay. Now, what is annual yield of 5%? What is 5%? 5% is effective interest rate. Like the last class we did, remember cost of equity, cost of capital, required rate of return. This is the required rate of return. This is nothing but the required rate of return, which is also called as effective rate, which is also called as effective interest rate. They're also telling you use the effective interest rate method to compute. So this is most important. Why? Because this is your rate in the market. I don't care you give me 2% or 3%. Market rate is 5%. Now let's understand one thing. You guys think carefully. If a bond is valued at $1,000, the face value, but the bond is paying only 2% interest, will this bond sell at a premium or a discount? Is this a good bond or a bad bond? Valuable, not valuable? Answer. Market rate is 5%. Bond is paying you 2% discount. This bond is a useless bond because it is paying you less than market. If this bond needs to be sold in the market, it can sell only if the market price is discounted. The bond value is 1,000, market price 900. Why is it 918? Because it is a discount. And why is it discount? Because the coupon is less than market. कौन बेवकूफ जाके ये bond खरीदेगा when he can go in the market? Right? Market gives 5%, so no fool will buy the bond unless you give an incentive. So logic is what? Discount because the coupon rate is less. Okay? Now let's understand the process of amortization. This is called amortization process. Okay? Now what happens is this. The bond face value is 1,000, which means on maturity, I will get $1,000 or I have to pay $1,000, right? It depends on who's the perspective. Let's say you're an investor. If you buy the bond, you have to pay only 918. Same for the company. The company that sold the bond receives 918. Right or wrong? The company receives 90 because it is sold for 918. So the company's opening liability will be 918, not 1,000. Because 1,000 it has to be after 3 years. But today, when it issued the bond's value in the balance sheet will be only 918. Clear? Clear this? Now, you need to do 2 things every year. Only 2 things. Only 2 things every year. What are those 2 things? You will record interest expense every year using the which method? Effective interest rate method. What is effective interest rate method? Formula, what I told you? It is what? Opening liability into effective interest rate, right? You only forgot. Opening liability into opening interest, okay? This is the charge you will incur every year. This is the charge to P&L because this is the amount you should have paid. But you chose to pay this amount. You chose to pay only 2%. So you are paying in cash. Your cash flow is only 20, 20, 20, but you should have paid 5%, 50, around 50, 50, 50, right? So this is what you should incur. This is what you actually paid. Understand now. This is the liability. Your liability will increase by the amount of interest you should pay, right? Have to pay interest. It goes up. But you paid only so much. So your liability went up by 45 and reduced by 20. What is your closing liability? 918 plus 45 minus 20, that gives you 944. Clear? Now 944 is the opening liability next year. What is the effective rate? 5%. Check, do on your calci. If 944 into 5% will give you 47.21, which you will add, you are anyway paying 20, you will now get 971. Check your calci, everyone. 918 into 5% gives 45. Minus 20 will give 944. 944 into 5% gives 47. Add, you will get minus 29. Now again, the last year you will again incur 5% off. Now you'll notice the amount increase because your liability increasing, right? You'll get this. Again, you pay 20. You'll notice in the last year bang, your answer is 1,000, which is what you will redeem, and your work is done. You were supposed to redeem 1,000. You redeem 1,000. Perfect. Are we clear? So this is the accounting movement. This is very important to learn, right? Why is it important? Because I hope you realize every year I am opening my balance sheet and I am increasing it every year by an amount which is equal to interest minus coupon. 45 minus 20, 25. It increased. 47 minus 20, 27. It increased 27. 49 minus 20, 29. Increased 29. Every year it increases by an amount based on the maths. And this increase every year is called as amortization. Got it? So suppose I tell you, what is the amortization in year 1 or year 2 or year 3? It's easy. Find out this, minus is the first year's amortization. Amortization is nothing but the value of the bond has gone up from 918 to 944. That is called amortization. That's why I told you, if you remember on the earlier slide, you will value the bond at amortized cost. This is the amortized cost of year 1, year 2, year 3, balance sheet 1000 goes out in year 3. Got it? I'm not doing fair value. There's no fair value concept here. This is amortized cost. Are we clear? In the CFA exam, they may ask you, compute the amortization in year 2. So you have no choice but to find out this value, then do 5%, get this value, minus 20, get the value, and that's the option that you have to choose. Clear? So that's the way they'll answer question. So let's understand, because you started at, remember your end point is 1000. Because you started at 918, you realize that this is at a discount. Therefore, this value will go up. And will go up. In year 1, it became 945. In year 2, it became 921. In year 3, it became 1000. This value will go up because it is called amortization upwards, because this was at a discount. Here, and you'll notice the effect is here to see. If it was at a premium, then it will have gone down. Clear? So a discount bond will amortize upwards. A premium bond will amortize downwards. Par will go stable. Now, when will it be at par? It will be at par if 1000 bond is sells for 1000. When will 1000 bonds sell for 1000? Answer. Now, you know this bond sold for discount. When will it sell at par?
When yield and coupon is like a same.
5% and 5%. If this was also at 5 and this also 5, it was done at par. There will be 1000, 50, 50, 1000. 1000, 50, 50. But when it's a premium, this will be probably 8%. This might be 5 premium, 2, 5 discount, 5, 5 par. Are we clear? So good. Everyone's got this meaning, right? Okay. You got the formula. This table is very important. Multiple sums can be asked. They can ask you compute the year 2 amortized cost. Compute the year 3 amortization charge. Don't worry, it's a charge. Why is it called a charge? Because my effectively income statement. If they ask you what is year 3 interest expense, the answer is not 20. The answer is not 28. The answer is 48. This is my interest statement charge for respective years. Clear? So this table has a lot of important answers. Okay. So quickly take a note on your calcs. You can do that. Okay. But you other table understand the details of this note. How to do it? Opening liability is 918. Okay. Plus interest is opening into EIR. Minus coupon, and you get the, this ignore for now, equals to 944. Opening liability into 5 plus minus. Opening liability into 5 plus minus. You're bound to get the answer as 1000.